This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 13 May 2026.
Thank you. It's great to be here to discuss this.
So imagine holding tens of millions of euros in collateral to secure a cross-border loan. Your borrower defaults.
Right.
You move to take possession of the assets, but your custodian bank puts you on hold. Why? Because of a missing signature on a paperwork technicality. The assets remain frozen.
Yeah, and that is exactly what you want to avoid.
Exactly. So today's deep dive is about making sure that scenario never happens to you. We're exploring the Luxembourg Financial Collateral Framework, and specifically, we're looking at the mechanism of appropriation under the law of 5 August 2005.
Which is a highly constructive framework for cross-border financing, as long as it's executed properly.
Right. If you are an independent Luxembourg counsel or, say, a professional structuring private banking credit operations, you already know this. But having a great legal framework is, well, it's only half the battle. We need to talk about flawless operational execution.
That really is the pivotal question here. I mean, the Luxembourg framework is intentionally designed to provide a highly reliable, insolvency-resistant environment for secured lending.
Mm-hmm.
But when properly structured, it offers unparalleled security. Today, though, we need to step away from pure theory and look at the mechanical reality of how this actually functions when the pressure is on.
Right, because it requires 4 specific elements to be perfectly aligned. You need the pledge agreement, the valuation method, the enforcement event, and the account control mechanics.
Exactly. If even one of those elements is off by a single millimeter, say, your custodian's consent process is not perfectly aligned, the process simply stops.
But before we get into the mechanics of those 4 elements, let's just define the core concept for the listener. What is appropriation mechanically, compared to just selling off the assets?
Well, the distinction is entirely about control and friction. Selling instruments in the open market introduces variables you simply cannot control.
Like market liquidity issues.
Exactly. You face execution timing risks, sudden gaps in liquidity, transactional friction. Appropriation, on the other hand, is the enforcement method where you, as the pledgee, simply take ownership of the pledged financial instruments at a pre-agreed valuation.
So you just assume the assets directly?
Yes, bypassing the open market entirely. But, as you said, if the legal pledge agreement says one thing, but the valuation method is ambiguous, or, the account control mechanism requires the defaulting client to approve the transfer,
which they obviously won't do.
Right, then the entire structure collapses. All 4 elements must operate as a single unified system.
Now, I want to clarify something regarding the timeline here. Whenever we discuss regulatory frameworks, the immediate worry is always, is there an impending compliance deadline? Are we rushing toward a new 2026 deadline for this appropriation mechanism?
Not at all. There's no new statutory deadline driving this specific mechanism right now. The Law of 5 of August 2005 is a well-established, incredibly stable piece of legislation.
Okay, that's reassuring.
Yeah, the focus for you as practitioners is entirely on internal hygiene. It's about the precision of your drafting and your operational readiness. When you're reviewing these structures, it's essential to use Legilux as your authoritative legal source, because that provides the binding texts.
And the CSSF consolidated texts.
Right. Those serve as your practical working references, compiling the various amendments into a readable format.
So the ultimate takeaway here for the practitioner structuring these deals daily is that the best security clause is not necessarily the longest or the most aggressively drafted one.
No, not at all. Nah.
The best clause is the one that your credit risk team, your legal department, and your third-party custodian can actually execute on a Tuesday afternoon without triggering an administrative backlog.
That is exactly the mindset you need. I mean, the entire purpose of taking security is recoverability. A pledge is only as valuable as your ability to enforce it when the borrower stops returning your calls.
So let's break down the underlying architecture. Who are the specific actors moving these pieces, and what exactly counts as collateral?
Well, you're generally looking at 3 primary actors. First, you have the pledgee, that's the lender or the private bank extending the credit.
Right.
Second, the collateral provider, which is your client or the holding entity pledging the assets. And third, the custodian or the account bank, which maintains the securities account where those pledged assets actually sit.
And the collateral itself?
The pledge creates a security interest over collateral, and under the Luxembourg regime, this explicitly includes financial instruments and claims.
Okay, I'm going to play devil's advocate here regarding jurisdiction because cross-border finance is inherently complex.
Yeah.
You might have a borrower in London, a lender in Geneva, and assets booked somewhere else entirely.
Sure.
To ensure absolute certainty, exactly where does this Luxembourg framework apply?
The jurisdictional trigger is remarkably clear, actually. The Luxembourg financial collateral regime applies when the pledge agreement is explicitly governed by Luxembourg law, or where the relevant book entry securities account is maintained in Luxembourg.
Okay, so it's tied strictly to the account location for digital assets.
Exactly. For book entry financial instruments, meaning digital assets held in an account, the law of the country where that relevant account is maintained is what governs the key proprietary effects in enforcement questions.
And what actually initiates the process? When is this mechanism activated?
It's triggered by an enforcement event. Under the framework, this means an event of default, or honestly, any other event whatsoever that the parties have agreed upon, where the collateral taker becomes entitled to realize the collateral.
So it's quite flexible.
Very. It also applies where a closeout netting provision takes effect.
Yeah.
The framework gives you immense latitude to commercially define what constitutes that triggering event.
But here is where I want to push back a bit on the operational reality. We keep talking about legal certainty, and we know the commercial imperative is immediate usability of the collateral.
Yes.
But if I'm a lender dealing with digital book entry instruments, how do I actually prove possession of something that only exists as a digital line item on a server? There's no physical stock certificate to hold.
That is the critical question of control, and it's where Article 20 of the Law of 5, August 2005 becomes essential. Article 20 is what makes these arrangements notoriously insolvency resistant.
Right.
It confirms that your agreed enforcement measures are valid against third parties, receivers, and liquidators, notwithstanding winding up proceedings. But to harness that protection for digital assets, your contract must strictly establish a clear control path over the account.
Let's unpack that control path. How do we build it mechanically?
You basically have three primary avenues. First, the custodian can act directly as the pledgee. This is common in private banking Lombard loans, where the bank lending the money also holds the client's account. It's highly efficient.
And the second?
Second, you can implement agreed custodian control instructions. This is a tripartite arrangement where an independent custodian agrees to take instructions exclusively from the lender upon default.
Okay.
And third, you can use formal account registration and designation, literally legally tagging the account as pledged.
So if I'm using that second method, the agreed control instructions with an independent custodian, this is where your operational setup can really fail, right? Because an appropriation clause is not just a decorative paragraph to make the contract look robust, it's an operational necessity.
It is entirely an operational necessity. You are managing an ecosystem of documents, not isolated contracts. Your credit agreement must clearly define the default. Your pledge agreement must state exactly when appropriation occurs. And crucially, your custodian arrangement must permit the transfer of those assets without requiring a fresh consent process from the collateral provider at the exact moment of enforcement.
Which would be a very stressful realization for a credit risk officer. Imagine drafting a flawless pledge governed by Luxembourg law, but at the moment of default, the custodian's standard operating procedure requires the defaulting client to log in and authorize the transfer.
If that happens, the mechanism fails fundamentally. The legal certainty provided by Luxembourg law cannot overcome a custodian demanding a signature that a defaulting borrower will never provide.
Exactly.
That consent must be hardwired into the instructions from day one.
So let's move to the valuation method. This gets complicated when we talk about undertakings for collective investment or funds, which are obviously central to the Luxembourg ecosystem.
Absolutely.
If a bank is appropriating fund units to satisfy a debt, how do they mechanically determine what those units are worth on that specific day?
The framework provides very precise distinctions based on liquidity. For fund units or shares admitted to a trading venue, appropriation may use either the current market price or the last published net asset value.
Okay.
However, there's a strict statutory condition. That last published net asset value cannot be older than 1 year.
And if the units are private or simply not admitted to a trading venue?
For units not admitted to a trading venue, your statutory reference is simply the last published net asset value. But again, it remains subject to that exact same condition. The valuation must not be older than 1 year.
Why that specific 1 year cutoff? What's the underlying logic there?
Well, it's about economic relevance and fairness. Illiquid funds might not price their net asset value daily or even monthly. But if a bank is taking ownership of an asset to clear a debt, using a valuation from 3 years ago is economically disconnected from current reality.
That makes perfect sense.
Yeah, if the valuation is older than a year, the statutory condition is breached, and your clean appropriation process is thrown into legal limbo.
And what about the cost of setting up this robust operational setup?
The costs are primarily administrative. You're looking at legal review, the coordination time required to establish those tripartite control instructions with the custodian, and internal documentation time.
Right, so it varies.
It varies wildly. You really must consult your specific service provider's tariff. There is no one-size-fits-all number.
But having this perfectly drafted contract means nothing if the underlying market structure shifts beneath your feet. We can't look at the Law of 5 August 2005 in a vacuum.
No, definitely not.
Which brings us to the broader operational context and the CSSF's recent regulatory communications from 12 May 2026.
Exactly. Market practice views the Luxembourg Financial Collateral Framework as a true execution regime. The 2022 amendments prove this by clarifying the appropriation of fund units and the redemption of pledged shares. It is continuously refined for execution.
Right.
And the CSSF's recent communique regarding the Law of 5 May 2026, which transposed CRD and Directive EU 22/42994, is part of that evolving landscape.
For the practitioner listening, how do we translate those acronyms? What does the transposition of CRD6 mechanically change for their operations?
It fundamentally updates internal governance parameters, it formalizes requirements for third country branches, and refines fit and proper procedures.
So, for example,
For instance, if you're relying on a third country branch acting within your collateral chain, the governance and authorization frameworks surrounding that branch are being tightened.
I see.
Furthermore, the CSSF confirmed that Circular CSSF 12552 remains in its current status pending future updates, which provides temporary stability while these new governance rules bed in.
But the update that really stood out to me on 12 May 2026 wasn't just about governance, it was about market operations. The CSSF highlighted the market's readiness for the move to T+1 settlement under the amended Central Securities Depositories Regulation, or CSDR.
Yes.
I want to spend some time here, because the friction of T+1 settlement really applies pressure on these collateral agreements.
That is a highly accurate way to view it. Under Regulation EU number 22520CO75, the market is compressing its settlement cycle from T+2 to T+1. We are losing a full 24 hours in the settlement process.
Explain the underlying mechanics of that for a private banker on a Tuesday morning. What does losing that 24 hours actually mean for collateral enforcement?
Well, in a T+2 environment, if there's a slight operational delay, say a delay in valuing the collateral or a minor communication lag with the custodian, you have a buffer day to manually resolve them before the settlement fails.
Right.
In a T+1 environment, that buffer is completely gone. The trade happens, and settlement must follow almost instantaneously. If your pledge agreement requires manual intervention or if your valuation method takes 2 days to calculate, you will fail the settlement window.
Wow, okay.
The tightening time frame means your transfer mechanisms now have zero margin for error.
So a poorly drafted custodian instruction isn't just a legal annoyance anymore. Under T+1, it becomes an immediate operational failure. Let's nail down the timeline for these shifts.
Wow.
We only deal in officially scheduled, confirmed dates on this deep dive. What are the specific milestones you need to track?
There are 3 specific dates you must integrate into your internal planning right now. First, regarding the settlement cycle compression, the CSSF T+1 readiness surveys remain open until 9 June 2026.
Okay, 9 June 2026.
Second, the official EU migration to T+1 settlement is scheduled for 11 October 2027.
Right.
And third, regarding the CRD VI implementation, the provisions relating to third country branches and the third country regime for banking services formally apply from 11 January 2027.
Excellent. So let's bring all of this together. The 2005 law, the valuation rules, the T+1 pressure into one practical end-to-end scenario to really demonstrate mastery of this framework.
Sure.
Imagine a private bank grants a Lombard loan. This loan is secured by a diverse portfolio consisting of both listed securities and non-listed fund units.
In that scenario, if you wait until the borrower defaults to test your documentation, you have already failed. The true work happens long before the signature page is even drafted.
Right.
The practitioner must confirm that the entire document architecture operates as a single, coherent system before a single euro is drawn down.
So step by step, how does the bank mechanically verify that readiness?
The bank must ensure it has the operational capacity to execute 5 specific steps seamlessly. 1. It must be able to clearly identify the pledged assets within the digital book entry account.
Okay.
2. It must be able to legally prove the existence and scope of the pledge without ambiguity. 3. It must be able to instruct the custodian immediately upon the enforcement event, relying entirely on that pre-agreed control path we discussed earlier.
No fresh consent?
Exactly, no fresh consent. 4. It must have the precise mechanisms in place to value the instruments quickly, using the market price for the listed securities, and ensuring the last published net asset value for the fund units is not older than 1 year.
And the final step?
Step 5. It must be able to seamlessly apply those appropriated proceeds to the secured obligations well within those compressing settlement windows.
The ultimate objective here is elegance in execution. You're not trying to draft a louder, more aggressive legal clause. You're aiming for a cleaner one. You want fewer moving parts, fewer manual sign-offs, and fewer administrative bottlenecks at the time of enforcement.
Yes.
That clean engineering directly translates to better internal credit comfort because the security package actually reflects how the assets are controlled in reality.
That is the ultimate value proposition. Luxembourg's financial collateral framework is built specifically for account-based financial assets, cross-border financing, and insolvency-resistant enforcement, which makes it an exceptionally reliable environment for private banking credit operations.
Which leaves us with a final, slightly provocative thought to consider. What if the very regulation designed to speed up our markets, like the compression to T+1 settlement, is actually exposing the hidden administrative flaws in your legacy pledge agreements? It is definitely worth auditing those custodian instructions today before the market tests them for you. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.